The dollar gained ground for a ninth week in a row last week as the US exceptionalism theme continues to rumble on while equities rallied, with the UK leading the way as treasuries trod water after hotter than expected US inflation data and a dovish surprise hike from the ECB. Speaking of central banks, a central bank bonanza awaits this week. Decisions from the Fed, the BOE, the BOJ and much else besides, leaving myself and Ryan Littlestone with plenty to dig into on the trade-off this week. So without further ado, let's get into the show. So it was a busy week last week, and it's going to be an even busier one in the financial markets this week. Let's bring in my co-host, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, are you rested, refreshed, and ready to go and attack the new trading week?
No.
You can tell we script these intros really well.
Yeah, you know, this is why we're here, isn't it? All these big weeks. Every week's a big week since the last big week. Yeah, it's going to be another busy one. Lots of central banks to get us teeth stuck into, data as well. So, yeah, all fun and games. And hopefully we'll get some questions answered rather than more questions raised.
Well, fingers crossed. I mean, it's interesting you say that because a lot of the time these big weeks do tend to produce more questions than answer them, actually. But yeah, it is a very, very busy week from Wednesday onwards. Certainly markets starting on a little bit of a quieter footing today, but that's no surprise. I'm sure volatility will pick up as we get into some of those key risk events a little bit later on in the week.
Yeah, definitely. We've got a few bits and pieces, got some Canadian data out as well, CPI. So that might get the CAD moving a little bit. I know you're talking about that one. So, yeah, lots to get our teeth into.
Indeed, yes. So let's do just that in Topical Thunder. Now, if I'm being honest, I think Ryan and I could probably have come up with about 8 or 10 of these little topics this week. There's so much going on, but we've managed to whittle it down to 4, and I'm going to get things underway with the ECB. A bit of a surprise from Lagarde and co last week, at least to me. I know some others out there were calling for a 25 basis point hike, and I'm sure were positioned thus, and that's exactly what we got from the ECB last week, raising the deposit rate to 4%, which is actually a record high since the inception of the institution, all the way back at the turn of the millennium. What's interesting, though, is a couple of things around this hike. It comes as, well, we all know the growth outlook in the Eurozone is deteriorating pretty quickly, not only from the data that we're getting in terms of the PMIs, the GDP numbers. You can also tell this from the ECB's own forecasts, with the GDP calls for the following 3 years all being revised lower, if I remember correctly. But what was also interesting about the ECB's decision was that it was a dovish hike. And I know that could be a little bit of an oxymoron, but I guess that's the best way to describe it, with the ECB's statement giving pretty clear guidance that they're now done and dusted, that they've reached their terminal rate. And President Lagarde said in the post-meeting press conference that the focus for policymakers is now going to be much more on the duration of time that they spend at their terminal level rather than the ultimate level that rates get to. So pretty clear that the ECB are joining that camp of the Bank of Canada, the Reserve Bank of New Zealand, the Reserve Bank of Australia probably in there as well, who have all wrapped up their tightening cycles. And amid that backdrop and throwing in the rather grim growth outlook, the fact that the ECB reckon inflation is still going to remain north of 2% all the way to the end of the forecast horizon in 2025. I mean, I found it tough enough to see a bull case for the euro anyway. I think I find it even tougher to do so now with, I'm going to be honest, Lagarde possibly on the cusp of a policy mistake a la Jean-Claude Trichet all those years ago.
Well, I've noticed you've already bottled it, because in your notes you weren't going to call her Lagarde, you were going to call her the permatanned one.
I was actually. I missed that out of my notes. She was looking slightly pale actually last week. I must be honest.
Yeah, well, I had to check my colour chart, as you know, that I run every ECB meeting to see what shade of tan she is, to know whether she's neutral, hawkish, or dovish, and
scarfless as well.
Yeah, exactly, and what she's wearing. But yeah, Queen Sunbed, she definitely pulled a rabbit out of the hat there. Yeah, I was saying last week, I felt that that there was a more of a risk of the ECB hiking than the market was predicting, although it did ramp up those expectations quite significantly in the week leading into the meeting. So it became a sort of buy the rumour, sell fact event in the end. No surprise that it's potentially one and done from them. Inflation is still the big problem for them, or the big thing they need to worry about. That's their mandate, after all. So that's top of the list, and that's reflected in the statement they put forward, the inflation forecast before the GDP forecast. So it tells you where their line of importance is. So are they done? Well, we have to wait to see the CPI numbers. It's still expected to stay hot, still expected to stay sticky. And I think that's going to keep the doves on their toes a little bit. If we get some hot prints coming in the next month, that will keep the pressure on. Pretty much, though, every hawkish member that's been out since has said, yeah, now we're in pause, although the door is still open for another hike. So, yeah, the upside for the euro based on monetary policy is probably limited. Now we're moving into the growth game and playing that off against every other country.
Yeah, absolutely. Relative growth is definitely, rapidly, if it hasn't already becoming the theme driving the G10FX space. It's interesting you mentioned the ECB's hawks. I mean, they've kind of been desperately clinging on to this idea that they could hike again. Are they going to go in October? Are they going to go in December? I think one of them, is it Casimir, was on the wires this morning talking about, if we're done on rate hikes, then we should start to quicken up the quantitative tightening process and running down the balance sheet. And I just can't see any of that really happening at this point. I think, if anything, for me, I think the ECB are more likely to be rushing to reverse some of the tightening that they've done rather than add to it.
Well, I'm going to disagree there slightly, because you're right. Casimir this morning, and I think we've had 2 or 3 others as well talking about QT and how, before they potentially even look at rate cuts, they'll need to drain the system, get some of this liquidity out of their balance sheets and whatnot. So I think that may actually become the next hawkish slant, if you like, going into ECB meetings. Are they going to increase QT? Because I don't know what they can do in terms of, all the stuff that's sloshing around, the liquidity still there, if they're having to cut rates. It'll act like a double bank of easing, if you like, and that's not where they're at. They don't need to ease wholesale. So I think maybe in the run up over the next few months into when a lot of people are expecting the first cuts to start coming in, maybe they will step up on the QT, and that might be seen as a hawkish slant. Yeah,
perhaps it's I guess time will tell which of us is correct on that precise view. What about me? What about moving on to this week then? I mean, the big event is always the Fed, isn't it?
Yeah, we always got to look at the Fed, the biggest one of the lot. And, pretty much the world and his dog expect the Fed to stay unchanged this week, but many still expect another hike sometime this year. The rate pricing shows that another hike is between 31 and 37% chance by year end. And for cuts, pricing starts around March. There's a sort of 13% chance that we see a rate cut in March. But really, a lot of the market is pinning their tail on the donkey around June 2024 as to when the Fed starts cutting. The decision this week should be pretty straightforward. Even some of the most hawkish members have indicated their preference for a pause. The US data thus far hasn't been spectacular, but it's still better than the rest of the other countries. The jobs market remains strong, and according to the retail sales data, so does the consumer. However, there are cracks appearing. The consumer credit costs have gone up, and more finding that it's tougher to borrow. The tighter financial conditions seem to be biting a bit more nowadays. And we also need to watch inflation, because for the last 2 months, it's risen, albeit with lower core prints. And some blame of that inflation has been assigned to gasoline prices. But still, a third higher reading, another month of higher inflation on the headline, will start to indicate a bit of a trend forming, and that's when the Fed will start getting really scared. But like the ECB, I think there's a greater chance of a hike than markets predict. And as I said, I don't think that's as great as it was for the ECB last week. The message from Powell this week should be really, another fine line walking exercise about balancing out the risks on both sides, strong on the fight against inflation and the jobs market, the job not being done on inflation, but noting the effects of prior hikes filtering through. And I think that the big thing we need to watch is the dots, the 2024 dots in particular. This might give the doves something to grasp if we start seeing them moving lower. At the moment, the lowest dot is around 3.75%, with the majority 4.25 to 5.25%. But conversely, a shift higher in those dots is also possible, just to reinforce that higher for longer message and keep that hawkishness in there. For the dollar, the market knows that even if there is one more hike, it's likely to be the end for the Fed. So again, the trade is going to be pricing cuts. And the only way dollar might meaningfully gain from here is if the US continues to be the country with the least amount of economic problems.
Which it will.
There
we go.
You're saying that.
The Fed's an interesting one. I mean, as you rightly said, the decision itself is not where the focus is. I mean, if it's anything other than unchanged on rates and a relatively copy and paste statement from what they gave us at the July meeting, it would be an absolutely huge surprise. And I think the same goes for Powell's press conference, in all honesty, as well. I think if you take what the chair said at Jackson Hole and what he said at the July press conference, kind of smash the two together and you get a pretty good idea of what he's going to say this time around. I really don't see him deviating from that script too significantly. The dots are an interesting one. I think they're by far and away the most interesting part of the SEP, the Summary of Economic Projections. The Fed will double their growth forecast almost for this year, I would expect. But we kind of know that the economy is doing better than they thought anyway, so that's not going to cause too much of a market reaction. You alluded to this, and the key thing that I'm looking at in the dots is the dispersion. Basically, what's the gap between the highest and the lowest dot? Because at the minute, it's absolutely huge. I can't remember what it is offhand, but it's going to be somewhere between 125, 150 basis points. And if someone pulls up the dot plot on their screen, then they'll be able to measure that a bit more accurately than I just have. But I would expect that to become a lot tighter. And that would just imply that Fed officials have a lot more confidence around the path that the economy is taking. And I would expect that to tighten by the higher dots coming lower rather than necessarily the lower dots coming higher. So perhaps a little bit more dovish at the margin. The one point I would make just on the longer run dot plot and Fed rate expectations, and this is, I think, something that isn't getting enough attention in my very humble opinion. And this is that if, as the Fed expect and as pretty much everyone expects, growth is going to slow and inflation is going to continue to fade next year, in order to maintain the same real policy rate and the same relative policy stance, the Fed have to cut rates at some point next year. Now, what I mean by that is currently you're looking at a real Fed funds rate in the US of as near as makes no difference, 2%. The Fed funds rate is 5 and a bit. Inflation's 3 and a bit. The difference is about 2. This is all very unscientific, as you can tell. If the Fed funds rate were to remain at 5%, and inflation were to fall back towards 2%, your real Fed funds rate, your inflation-adjusted Fed funds rate, would actually rise. So by doing nothing and by leaving rates where they are, the Fed would actually be continuing to tighten monetary policy, even as growth slows, even as inflation wanes back to target. Financial conditions will be getting tighter and tighter and tighter, which is arguably at that point in the latter part of the economic cycle, not what the Fed would want to see. So I think we are going to see rate cuts next year. Powell is certainly not going to endorse that at this press conference, but hopefully that gives people a little bit of a monetary policy 101 on why, despite inflation remaining above target, the Fed is still telling us they're going to loosen next year and loosen to quite a significant degree. It's just to maintain the same policy stance rather than because they think, everything's going wrong with the economy and we need to hit the panic button.
Yeah, very, very well explained, Michael. And you're right. And I think where we're at now, into Q3 this year, it's more just about, like you say, reinforcing their current stance. They can move those 2024 dots a bit higher just to reinforce the higher for longer. because they can lower them again into the early part of next year or into the final parts of this year, just to again then send the message that perhaps the economy isn't doing as well, or we will be bringing rates down to a neutral level. That's what they want to do. That is the end game. So for now, I think they would be inclined to push them a bit higher, keep them higher, maybe move 2025 up a little bit as well, just to keep the message now. At the end of the year is a different story altogether.
Absolutely. And of course, the other thing, I know we've just spent 10 minutes discussing it, but the Fed love to tell us that we should ignore the dots anyway. So why would we do that in the first place?
Oh, we better get Kyriakos to scrub the last 5 minutes of this conversation then.
Kyriakos, please don't do that, because I've just made what I think humbly is a very good point, and I would hate for it to end up on the cutting room floor. Right, let's move on, because after the Fed on Wednesday afternoon / evening, depending on what part of the world you're in, we will roll on to the BOE, the old lady of Threadneedle Street, set to deliver what I would expect and what most expect will be the last rate hike of the cycle on Thursday. It's probably going to be a 25 basis point rate hike. That would take the bank rate to 5.5%. And yes, I still owe Ryan lunch for us getting to 5%, let alone getting 50 bips above that. Markets currently price around an 80% chance of the BOE delivering that 25 basis point hike. Although I would just caution that pricing, frog in my throat. That pricing is before the August inflation figures, which we get on Wednesday morning, a day before the BOE announcement, the day of the MPC's vote. So that may swing around a little bit in reaction to that inflation data, which should tick up actually a little bit to 7% on a yearly basis in August, again, driven by the fuel prices that Ryan mentioned a little bit earlier on. I reckon, as with the Fed, to be quite honest, most of what we get from the BOE will be relatively similar to what we've heard recently. The statement is unlikely to change too significantly. They added in the line in August that rates will remain sufficiently high for sufficiently long, and that they believe policy is restrictive. I think they'll repeat that at this meeting. Again, as we mentioned with the Fed, in terms of the dispersion, that range of views, I think that will tighten up a lot on the MPC, probably an 8-1 vote in favour of a move, rather than the couple of policymakers we saw voting for 50 bips, the one that we saw voting for unchanged last time around. I think it's going to be a much more of a straightforward decision on Thursday. The only thing that is perhaps up for debate is what they do on quantitative tightening. If you listen to the Deputy Governor, Dave Ramsden, he said recently that there's no real reason why the BOE can't quicken the pace of their gilt sales. In fact, of all the G10 central banks, the BOE seem to be the ones that are in most of a hurry to trim down their balance sheet, only to then inevitably expand it again when the next crisis hits. But I guess it gives them more policy headroom to do so. They're currently selling off and running down about 80 billion sterling worth of gilts a year. That will probably go up to about 100 billion. It won't have too much of an impact on the gilt market. If it would, then they wouldn't do it, because the last thing they want to do is cause market instability, as we had almost exactly 12 months ago to the day, although that, of course, wasn't the BOE's fault. As I said, I think it's probably going to be the last rate hike of the cycle. The economy is looking to be heading south pretty quickly, with all the PMIs now below 50, and of course this remortgaging cliff getting ever closer. We had a dismal jobs report out of the UK last week as well, unemployment up to 4.3%. I think the BOE are very, very unlikely to spring a hawkish surprise, and I'll get onto my sterling view a little bit more later on, but I can't see a bull case for the quid just yet.
No, and I think I agree with you on that as well. It is going to be hard to see the pound going higher. They haven't wanted to hike this far. They reluctantly went into the last hike as well. So, yeah, I expect another one and done. What I would say is that, again, inflation is ticking up. We expect it to tick up 7.1%, I think, but the core is expected to come down a pip. I'm in two minds about this inflation data. We may still have some of that fallout from the wages coming in, but also the energy price cuts coming out of that as well. So it's a bit of a coin toss what happens in this CPI report, but it will determine the last minute expectations for traders going into the BOE as to whether there is more to come perhaps from rate hikes. But yeah, I expect, Bailey to try and walk the fine line. He'll probably fall off it a couple of times like a standard drunk walking down the street. But yeah, I expect the message to be pretty much the same. We're hiking. We expect, or we're going to keep the door open to further hikes if inflation doesn't play ball. But we are pretty much done and in restrictive territory. I think maybe the votes, there might be a couple more who vote for unchanged, just to, again, send that message that we're potentially at the end of rate hikes. Again, doesn't mean they can't change their mind later on, but it just, again, a bit like the dot, sends that message to the market that, yeah, you need to take what we're saying, for, not with a pinch of salt, but in reality. And for the pound, yeah, I think if there is any upside over the decision, then potentially we're going to see the same thing, maybe a little bit of upside and then quickly sold in after. But the quid's looking a bit weaker around the grounds this morning.
Yeah, it certainly is. I mean, I think just once more for those at the back, really, the message from central banks is we are done, but we will go again if we have to, if the data says we have to. We've heard it from the RBA, from the RBNZ, the BOC, the ECB last week. We're going to hear it from the BOE on Thursday. We'll probably hear it from the Fed at some point, perhaps after a hike in November. And I wouldn't have thought the Scandi central banks and the Swiss National Bank, who we also hear from this week, are very far behind. And as you've called for, well, probably 3 months or so now, mate, it is now getting to that point of where does growth hold up the best for the longest and who maintains rates at terminal for the longest. And that's with the currencies, particularly in the G10 world, that we're likely to see outperform over the medium term.
Yeah, definitely. And speaking about, the rate cut trade coming into effect end of this year, early next year. And I think the UK is going to be one of the candidates you need to watch because if rate hikes do really bite, it's one of the ones that may see activity dropping the worst.
Yes, and if the BOE were reluctant to put rates up, then they're going to look for every excuse they can to jack rates, or to push rates back low. You jack them up and you push them down. There we go. Speaking of keeping rates low, why don't we head over to the land of the rising sun? Yeah,
the Bank of Japan. And this meeting got interesting after Ueda's comments last week about the possibility of ending the negative rate cycle. What the market took as some hawkish comments forced some of them to come out a bit later in the week, government officials and the like, to say that he hadn't really said anything new and that perhaps the market had misinterpreted his sentiment. Either way, this meeting's importance has grown, and now we'll be waiting to see if he clarifies those comments at all. If he dials back on those comments, saying that the market got it wrong and he was only suggesting one possibility, then in the end he's likely to get hammered again. If he does come out and largely repeats that the end of negative rates is a possibility by year end, and we'll need to know if that means calendar or fiscal, because we were a little bit uncertain on that on the comments last week, we could see a similar move to that of last week where the yen strengthens and we see yen pairs coming down. So far, the fundamentals remain positive in Japan, and although the rise in inflation has tailed off a little bit, it remains sticky and is going to put pressure on the BOJ's message of it falling back in the latter part of the fiscal year. And we've also had PM Kishida readying more consumer price crimping and wage stimulating fiscal bazookas. He's hoping that a bounce in spending and activity will bring a boost to the government coffers, which should go some way to paying for all the borrowing they may need to do to initially pay for it. Now, in the near term, that should keep the yen on the weak foot in the short term, and the Bank of Japan on the easing path until the data confirms his measures are working. In reality, it's a bit of a hope trade from Kishida, but they've got to do something over there. So just to summarise, I'm looking for the bank to reaffirm their stand on easy street and for Ueda to clarify those comments from last week.
Right, Ryan, one question and one question only. Do I need to get up at 4 a.m. for the BOJ this time around?
Well, it'd be a dereliction of duty if you didn't, mate. And I hope you are, because then I can stay in bed and you can tell me what happened when I get up.
Teamwork makes the dream work, as they say. Teamwork makes the trade-off work, doesn't it? So I'll have a line and you can watch it for me.
I'm in two minds whether to get up for this one. I'm not expecting any big fireworks. It would be nice to hear if we get some clarification on those comments. But it's still going to be a long way out before they actually do anything. So, yeah, maybe I'll stay in bed for it.
Yeah, I mean, I certainly don't expect, this is going to be famous last words, isn't it, by Friday morning. I certainly don't expect any huge volatility in the yen over the BOJ. As you say, it would be nice if we did get a bit of clarity on those comments. A couple of actually interesting things have happened in regards to those comments since we filmed this show a week ago. The first was, and I was actually reading this on Bloomberg on my way home last Monday after we had filmed. And I can't remember who wrote the column now, so do forgive me for that. But it was actually a Japanese chap had read it in Japanese and was saying that in Japanese, the comments were even more caveated and watered down than they were once they've been translated into English. So I do wonder whether there was a little bit of kind of lost in translation going on. The other thing that I thought was interesting was that we got these comments on Sunday night at pretty much the Asia market open. And it took until Friday morning at about 5 o'clock London time for the BOJ to actually run this sources piece and start to push back on them. And, you know, that just told me that I think the concern came more in terms of the market reaction to the comments rather than actually the news breaking itself. You know, the fact that 10-year JGBs ripped up towards 0.75%, I think was the high, which was the highest since 2014. And that just implies that there's still a bit of a degree of discomfort, a bit of nervousness within the Bank of Japan around yields heading higher, around conditions tightening too significantly. So it's almost a classic case of kind of one step forward, two steps back going on here. You know, we hear something hawkish and then there's pushback on it, and then we might get an unchanged decision from the BOJ this week, and 2 weeks after UEDA's comments, we're back to square one again.
Yeah, it's all about managing their way out of this easing path that they've been in for decades, really. So they are scared. They are worried that they can't go too fast, because if they do, the market's really going to take off, which going to put pressure, especially yields. All the borrowing they're having to do over there for QE and whatnot. It's going to put a big pressure on that. And the Bank of Japan is running very much in line with the government. These measures from Kishida, getting wages up, that's the good side of it. These fiscal measures to keep gasoline prices, these subsidies going in to keep prices low, that's just delaying the inevitable inflation coming in via the back door. So they've got to go hand in hand, but it really is about the management. But you've got to look at history, and they don't mind dropping these little tidbits now and again just to gauge the market reaction, see what the market's going to move on, and then, again, they can manage that as best as they can.
Indeed. I'm just interested to see how this have your cake and eat it policy stance goes. I mean, you cannot raise your overnight rate and expect the bond market not to do anything. That's just, this is macro and markets 101. That's just not how this works. If you raise rates, yields across the curve will probably go with it, or if it obviously causes growth concerns, yields at the long end are going to come lower. But it's very, very unlikely that you're going to be able to come out of negative rates, even if it is only a 10 basis point hike, without causing some sort of ruction in the bond market. You're fighting a losing battle, I would argue there.
Yeah, possibly, but then that's why they're widening the band on YCC to account for that, and they can do that again even coming out of negative rates, maybe move it to 1.5% either side of midpoint. So we know what they are likely to do if they do come out of negative rates, and we've already heard if they hike 10 pips to zero, they're not going to call that a hike, they're just going to call it ending negative rates, and again that's the type of spin they're going to put on it.
Oh, it's like they've got the best marketing department in the world. Anyway, I've just noticed that we've already gone for half an hour and we're only a third of the way through the show. So we should probably press on and look at some charts. Right. I want to look at cable first of all. As we were mentioning briefly earlier, sterling is starting to look very soggy indeed, not only from a fundamental point of view, but also when you look at the chart. It doesn't take a technical analysis wizard to tell you that this does not look particularly good. Sterling's an interesting position. I mean, we're down, 6% or so from the cycle highs, which came in around 131.40. Sadly, we're only down about 2% from when I initially turned bearish on the pound, but one of those even a broken clock is right twice a day things. We traded back up to the 125 handle in the early part of last week, and then we kept going lower below 124, and then closing below the 200-day moving average for the first time since March this year, which is, 6 months ago or so now. Feels like it was yesterday. As we were saying earlier, I still really struggle to be constructive on sterling here. I think 123 is the next really key support for the pound. If we break below that, then you could be seeing the 120 handle in relatively short order. You've obviously got the 200-day moving average above at 124.30 and 125, the figure above that. Personally, I'm happy to keep selling rallies into that 200-day moving average. If we were to get a closing break back above it, then I may reassess things. But for now, I'm more than happy to be playing sterling from the short side.
Yeah, there's not much I can disagree with that. I'm in the same position, similar boat to you. I think, below 124.5, 125, it continues to look bearish. The levels are clear, as you say, 123. I even think now perhaps we might be heading to 120 just with this break that we've had already of 125, 124.5. So I think that might be on the cards, and that'll be a big level if we get down there. That may be a place where the market might take a little bit of a pause to see what's going on elsewhere. And I'll be a little bit interested in longs down at that level.
Yeah, I would actually agree with that. I think 120, if we do start to build a little bit of a base there and we can consolidate around that figure, then that might be the place to start trying to buy in and get in on the long side. But I think we're some way off that at the moment, to be honest.
Well, you never know, Cable could be there tomorrow.
Oh, please don't say that. It was September last year that we were literally there this time tomorrow. So let's not tempt fate again. Why don't we move swiftly on before we get onto that?
Yeah, well, I'm going to take a look at euro dollar. This one again, it's another level where we've held the break below, and both our plays of the day last week were euro dollar, and they both bore fruit in the end. And it was a bit of a perfect example of, how we can have opposing opinions on a trade, but it doesn't mean both sides can't make money. You're not trading against anyone else in this market, despite you may think about the big banks and whatever. It's really only you trading your own thing. So it doesn't matter what anyone else thinks. I got my long side ahead of the ECB. I got in the end at 107.10. I was looking to buy into that big figure just for a little bit of a run into ECB. I got some out, most of it out at 107.60s. Then Michael stepped up, got his little pop over the ECB announcement, and then it was all the way south through 107. So into and over the ECB, it became very clear that this 107 level was the only level to worry about. And that proved to be the case. If we held above, very likely a solid bottom forms. Get below, and it becomes good resistance. So a break it was. We closed the week down near the mid 106s. It confirmed the longest losing streak ever at 9 weeks, as far as I could see on the charts anyway. The biggest before then was an 8-week losing streak. So now we move to the Fed, and this level becomes important once again. Where we close post-Fed could be the making or breaking of this pair. Back above that 107, and the same applies that a solid bottom may be forming and put in place. Hold below, and we're likely to be going for a wander down to the big 105 level. Now, it's not very often you get such a clear line of distinction in trading. Your views don't matter. Our views don't matter. The Fed's views don't matter. What Powell says doesn't matter. All that matters is whether we're above or below 107 at the end of the Fed. And that's all you need to worry about when trading it.
Absolutely. Shall we both give ourselves a little pat on the back there for our plays of the day last week? It's very rare that we both end up in profit, particularly when we're trading the same pair from different sides. But as you say, a very, very good example of how that can work. And I completely agree with you. I mean, as most will know, I do have a sort of natural ingrained bias to be bearish on the euro. But if we can get back above that 107 handle, then it could be good for a brief, short-lived rally, and it certainly wouldn't be one that I'd be looking to fade until back up towards those moving averages just shy of the 110 handle. But watch that line in the sand, see how the price reacts, and if we're below it after the FOMC, then it's a great opportunity in my book at least to get short once more, or perhaps even increase that position if you're already playing things from the short side.
Yeah, and I would be looking at that 105 level. It really is a huge level. You can't really see it on that chart there, but it goes back some way. It goes all the way back to 2015 and beyond. So that 105 is really a doozy of a level. A bit like cable at 120. That's one I'd look at to potentially pick up some longs from.
Yeah, I'd actually even say longer than that. I mean, I haven't got it in front of me here. Obviously, I'm not running Bloomberg or any charting software while we're filming, but just from memory, I think 105 has been a pretty sticky level almost since the inception of the euro. Going back all the way to kind of 2003, 2004, when it was first tested as support resistance. It has been a really, really key level for the common currency over the years, and it will probably prove to be so again.
Yeah, very much so. And I expect to see some probably some barrier action down there as well, which is always interesting to trade as well.
Yeah, actually, I'm going off on a bit of a tangent here, but options are a bit of an interesting one. I'm sure you look at the daily FX option expiries before the New York cut. A lot of them are actually quite a long way away at the moment because we've had some fairly chunky moves over the last 2, 3, 4 weeks, and these are structures that are put on, over a month or 3 month time horizons. But yeah, as you say, around those big figures, there are going to be some, particularly the important ones. You would expect some significant interest in the derivative space.
Yeah, and just quickly, it's interesting you mentioned that as well, because when I look at the expirers, I do see an overview, and really all the main strikes are above where we are now. They're all sort of 109s, 110s, 111s, which can leave a bit of a gap below. If we do start moving down significantly through 106, then the option traders are forced to rush in, and because they haven't got coverage, and that can lead to a bit of a tailwind for the pair.
Yeah, absolutely. If anyone wants us to do a show on delta hedging, then I'm sure we can arrange that. But let's not go down that rabbit hole now. I'm going to go down the loony rabbit hole and look at the Canadian dollar. I mentioned oil last week. Crude, both Brent and WTI have continued to move to the upside. The bulls are still absolutely loving life there. Brent is charging onwards towards $95 a barrel, and WTI trading north of the $90 a barrel handle for the first time in about 10 months, I think November of 2022. What's interesting is that we are starting at long last to see some signs of life in the Canadian dollar, and that correlation that it has with crude starting to re-establish itself a little bit. The loonie was the best performing G10 over the last week, and if you look at the chart, you can see here that we've started to back away from this 137 level, which has proved itself pretty strong resistance on a number of occasions over the last 12 months. And we've come back to the 135 handle, which again has proved itself a pretty sticky level over the last 12 months or so. So I think if we do get a closing break below here, given how significant it's been while we've been in this broad kind of 131, 138 range for the last 12 months or so, then we could move lower to test those moving averages and perhaps even towards the bottom of the range once more. Is it going to be a bit of a shove from further upside in crude? Is it going to be a dovish surprise from the Fed that gets there? I'm not entirely sure. I would argue probably for the former rather than the latter, but the level is there if we do get below it. But if this does prove to be a failed break, and if this does hold as solid support once more, then I think we could be back at the 137 figure. So as you've said on many occasions, Ryan, the loonie is one that loves to respect the levels and the technical analysis. So it could be an interesting one to throw on the radar.
Yeah, very much so. I mean, the loonie couldn't buy a win in the last couple of months, and I have been feeling it. And I think I looked at the loonie last week or the week before. It's a pair I have been long off those 131s, and when we got up to that 137 area, it just smelt like a bit of a change. We had that higher CPI data, the Bank of Canada, Macklem turning a little bit more hawkish. Now we've had a break in oil, which now the Canadian dollar is paying attention to. Just sometimes you get a market and 1 minute, there's no love for the Canadian dollar. The next minute, all those factors come in and it's finding itself a bit more bullish. I keep looking at my screen at the moment because we've just had a break under that 135 down to 134.70, which is, I had a bit of a zone, and you've got the level there at I think 134.60 something in there, 134.64, that moving average. Yeah. So there's a bit of traffic at that level. So If we break that, then I think we're definitely heading towards 134. Could be a bit of a stop loss follow through on that number, but yeah, definitely the bricks are stacking up as to why the Canadian dollar should be a bit more bullish now.
Indeed. The only reason I'm not piling in on that view and that short dollar CAD position a little bit more is just because of that broad theme of dollar appreciation that I still expect to see. But if we do break that 135 level, then certainly I will be looking to get involved. Lastly, why don't we look at euro sterling?
Yeah, euro sterling, and this one's going to be front and centre of the growth race, if you like, between the Eurozone and the UK. We know the BOE is only expected to hike one more time. This might be a final chance to trade off the low end of the range before we maybe get a sustained move higher. Once the central banks are done, as we said, it's going to be the growth trade. And I think, as I said, the UK might suffer a bit more than the Eurozone. Michael's mentioned the impending mortgage blow up that's possibly coming. There is still a bit of divergence there because the UK will have a higher rate than the Eurozone. But if the BOE are forced to cut first, then that's going to flip the divergence trade right around. That might happen quite aggressively as well. So that will likely lead to the pound getting sold off in this pair and lift off for the euro sterling. I'm already long off that 85 handle. And if we don't try another test over the Bank of England, then I can see it moving up from there. Now, there's a couple of things to consider with this one. Obviously, the first one is inflation. That may be more sticky in the UK than the Eurozone, as it has been, throughout all the last few months. So further stickiness is going to be a bit of a headwind for this pair. Secondly, you need a lot of patience for this one, especially if you're trading it on the longer term. We've already spent the best part of 3 months trading around the 86 handle. We've had a few extensions up to 87s, down to 85s. So it is one that you need a lot of patience with. But what's good about that is that the cost of trading is much smaller compared to shorting the dollar against any other pair, particularly against the yen. So you aren't going to bleed money if you're sitting in a longer term position. You can let it run for a bit longer and it's not going to cost you much at all. Near term, 87.20 is the main level above. Take that out and we're going to be moving towards 90. But on the other side, if we get an 85 break, that's likely to push us down towards the early twos and a wider range that we've seen previously. So this is a good one. If you want to get in a longer term trade, get out of the volatility of the dollar and trade the differences between economies and central banks. This could be the perfect pair.
Yes, indeed. I like the rationale behind that one. I just can't see euro sterling going anywhere particularly quickly. As you rightly said, it is one of those that just likes to kind of plod along and take life at its own pace and not do particularly much for months. But when it does start to move, then it can move a little bit more rapidly and significantly. So, of course, do have those levels on the radar. And if one of them breaks, then, of course, you can take the appropriate position. But, yeah, personally, I just can't see much in the way of movement here. I think, relatively speaking, the UK and the Eurozone both have their own issues in terms of growth that is going to keep a lid on things. Maybe Europe marginally worse off than we are here in Blighty, but I think that difference is going to be relatively small, to be honest. And I know you mentioned the funding issues, but personally, if I was looking to buy growth in G10, I'd just be buying the dollar, in case people hadn't worked that out by now.
Yeah, perma dollar bull you. And everyone likes to be bearish over the UK, none more so than our own press at times.
Yeah.
So there is, if the UK economy is going to suffer, then you're going to hear all about it, how bad things are getting. But we do have a way of confounding those expectations sometimes and not being as bad as many expect it. So that'll be a little bit of a risk for this pair. But I still think, the weight of the Eurozone, so many more countries, that will always outweigh what happens in the UK, particularly in this pair.
Indeed, it's that sort of British bulldog spirit against that sort of shambolic fudge that we get from the EU every now and again, isn't it?
Oh, dear me, you're going to start bum fights all over the place now, aren't you?
That one might need to be cut out. Let's move on to our plays of the day. Right, well, speaking of British bulldog spirit, I'm going to look at the FTSE 100 this week. No, I haven't taken a charter cable and just turned it upside down, although you pretty much could have done, to be honest, given that the FTSE is almost entirely an FX play at the moment, rallying and outperforming as sterling continues to slip. And in fact, the FTSE 100 was the best performing developed market equity index on the week last week. The technical side of things looking pretty good as well. We're above the 100 and the 200-day moving averages, holding those on a closing basis, getting above 7,700 and holding that on a closing basis and on a retest as well, and popping above this trend line that's been in place if you draw it in from the highs that we saw back in February. So a bit of a longer term view here. It's going to be an interesting test if we can get above this 7,800 level. You can see how stiff a level that proved during the early spring when we were last here and trying to break through it and couldn't, and we then went on that prolonged run lower. But if we can, then I think I like the FTSE higher, back up towards that 8,000 mark perhaps. It's also worth noting that mid-September tends to be the seasonal bottom if you go back 30 years for the FTSE 100. So throw that into the mix as well. UK stocks, yes, they're cheap. Yes, they're unloved, but maybe, just maybe that could change one day soon. Ryan, speaking of unloved, what about the yen?
Yeah, we love a bit of dollar yen, and that's what I'm going to speak in about today. And long and strong is my sentiment for this one. Any downside move to that 107 area looks good for longs at the moment, unless the Fed turn uber dovish. I feel dips will still get hoovered up pretty strongly and quickly. As we mentioned, we could have a similar situation to the ECB, where a hike now will likely be the last. So we may see some dollar selling after the initial knee-jerk higher if they do hike. Once past that, we have the BOJ to worry about. And they're unlikely to change anything. And as I said, you either may have to dumb down some of those comments next week, the comments that he made last week. So when we're over that hump, the situation will be that the Fed is still running with high rates and the BOJ hike is still a long way away. So my trade here is to stay with the rate divergence trade for a while longer. Plus, as mentioned with euro sterling, it costs a lot to be short this one for any length of time, and it pays to be long. So there's not going to be too many takers willing to hold shorts for any great length of time. What I'll be looking for here is I'm already long a little bit up near the top here, but I would be looking for a dip buy into that 147 level for a break of 148. Get that, we may be heading to 150, and while that bring the jaw boners out, as long as it's not too volatile, that might be achievable.
Indeed, good stuff. Well, that does bring us to the end of another show, a very busy, jam-packed show this week. Hopefully plenty of value in there for traders all over the globe. If you have got some value out of the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me and trying to make sense of what's going on. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. And the three of us will be back again this time next week to try and make sense of the central bank bonanza that we've got coming up over the next 3 or 4 days. Thank you very much as always for watching. We'll see you then. Goodbye for now.